Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I'm delighted again to be able to speak to Richard Penny of Crux Asset Management, one of the UK's finest investors. So welcome, Richard.
Thank you very much. Nice to be here.
Yeah, happy New Year. Well, given the market at the moment, we've got a lot of cross wins here. We have the continued central bank tightening, the ongoing war in Ukraine, the cost of living crisis, but now sort of like offset by reducing inflation expectations, the reopening of China today, which is obviously a big deal. And we've had a massive, over the last 12 months, reset in stocks, in valuations. So putting all that together, what's your sort of outlook for equities for 2023?
Yeah, there's a lot going on there. So equities in general, I mean, the economy, I like to talk about recession. Well, the recession to some extent is in the price. So don't let the R word put you off things. But, a mild recession in the US, and we're probably already in a recession in the UK and Europe. So that's probably in the price. And there's been good news around inflation to some extent recently. We're seeing container rates out of China into Europe and things coming down fastly. They really peaked. And actually the gas price is really helpful. I mean, the gas price has come off way off the top. And that impacts all sorts of the parts of the economy, cost of running premises, fertilizer prices into food, and obviously it's a big issue for the consumer and for government finances. So, I mean, that's been a marginal positive. It looks like peak rates sort of 5%-ish in the US, perhaps 4% in the UK, sometime in the Q1, Q2. But of course, the stock market is usually 6 months ahead of that. So this is not news to those of us that follow the market. And if anything, the news about how high rates go and how drastically they are, it's sort of been tempered slightly. So it feels like there could be a pretty good recovery at some point.
Yeah,
this year.
And with that Fed, I mean, obviously this is the sort of the $64 million question. Is the Fed going to reduce interest rates? And obviously the yield curve is suggesting that they are going to the back end and then reduce them a lot in 2024. The sort of the way I look at it, I just wanted to get your view, is such that they keep saying they won't, but then equally sort of reiterate that they're data dependent. So on the assumption that the data is rolling over, isn't there an out there that they can reduce? I mean, it seems crazy that they're going to continue banging. Well, not. What's your view anyway?
Yeah, I mean, it's the thing we can't forecast. I mean, we have to admit at times you can't forecast it, but they have to promise to be draconian, otherwise people won't temper their actions. But in terms of the US, you've seen a huge number of job openings that just weren't getting filled, and you're seeing now some of the merchant banks and then the Amazons and the tech companies actually laying people off. So it feels like that excess demand is sort of tempering a bit. The idea that they bring inflation all the way back down to 2% before they start lowering rates, we don't quite know about, but that's not going to happen probably until 2024, for all that there are positive signs around supply chain and commodity prices. That's a bit of a conundrum, whether there could be a policy mistake where they keep rates higher for too long.
Yeah. And also, the one big feature of 2022 is that we've had a lot of sort of redemptions, cash redemptions on the fund managers, and that sort of artificially depressed prices, particularly in small cap land in UK. I mean, the valuations, in fact, right across the spectrum in the FTSE 100, 250, and on sort of AIM and the small cap, we're only talking of low sort of teens PE multiples. What's your view on valuations? Is there, if we get a sort of like a better sentiment, is there a chance we're going to see earnings hold up and sort of maybe even solid multiples?
Yeah, I mean, two things. I mean, I think in general earnings might be a bit worse than people expect. In a sense, people expect them to be worse than expected, if that's the sort of thing at a macro level. We're sort of perhaps at the worst point in the economic cycle where consumer demand is lower and inventory is a bit high because people order too much because supply chains. But if we come to small cap in the UK, I mean, it has been huge amount of redemptions, as you say. You've seen, huge institutional redemptions amongst the small cap, and the very, very few buyers, which makes it our buyer's market. And then you've also seen in retail, you've seen a lot of people, the retail investors came in Q2 of 2020. They bought some Amazon, Tesla, perhaps some of the Bitcoin type things, some COVID stocks. and all the profits and all the upside has been given back there. And you know, you hear signs of tighter margining, not much liquidity amongst market makers. So if you go down sort of lower than sort of institutional small cap at the 500 mark, if 500 million mark, if you come down to the 200, 300, under 100 million, lots and lots of bargains there. And you know, the one constant over 20 or 30 years doing this is that, you know, when you get a sell off for the next 7 or 8 years of the economic cycle, fund managers, sort of brokers, having drinks in bars, because why didn't we buy at the bottom? And you know, there's a lot of stocks where you could see how they could incrementally be a worry for the next 5 or 6 weeks. So, you know, could they be a bit lower? But they absolutely look great on a 2 to 3 year view.
Yeah, I'm with you. I think a lot of anybody who's got sort of cash on the sidelines is probably licking their lips actually over the next sort of 3 or 4 months. They can bide their time and sort of pick a nice few spots. Now, one area that just to go a bit further up the food chain into the commodities, which should continue to do well, particularly as China reopens, is Glencore, which I noticed in your portfolio. And obviously that's a sort of like it's, you know, sort of base metals, but also coal and stuff. And it's trading, even though it's obviously done well last year, it's still trading on a sort of PE multiple of only 7 times. It's got big sort of dividend yield as well. What's your sort of latest on Glencore?
Yeah, so they've probably been over trading in coal. So the dislocation in the Ukraine and with Russia and everything. Obviously, we've had to find fossil fuels for places, and coal has been the answer in Germany and these sort of places. So, you know, coal was up at $350, and it's sort of halved. And Glencore was making over, you know, making about 20 million of EBITDA, sort of cash flow, of which more than half would have been in coal. So that's going to come back. The flip side to that, though, as you say, on the industrial metals, copper, cobalt, nickel should be stronger. And of course, those are sort of battery metals. So you've got offsetting factors. But of course, coal was never really richly valued in the kind of ESG environment we're in. Sort of people were sort of valuing it 2 to 3 times cash flow. And of course, the cash flow is much higher. They bought back shares. And to some extent, it's, you know, it's cheap, as you say, there's lots of cash flow. It has a bit of security for, you know, gas prices have come off. But of course, you know, we've had very sort of mild weather really actually in recent weeks, but that could change. And so it's got a nice sort of insurance sort of policy around the portfolio really.
Yeah.
For if there were a spike again in carbon pricing.
Yeah, I know Martin Gilbert, actually, who's one of the directors, is not surprisingly is very positive on it. So
yeah, I
think that's probably a good sign. Now I'm just moving to a really quite a beaten down area. There's lots of opportunities into consumer. And we'll start with the small cap and then go to some big caps. We've got CBOX. Now I understand about 12 months ago you bought you sort of took the chance to sort of bought quite a few shares in it. And likewise, I know the CEO and the COO also have bought significant sums over the last year. And it's trading at, again, about sort of 10, 11 times franchise, or one of the sort of the UK's sort of go-to providers of sort of like, you know, not fresh cream cakes.
Yeah, birthday cakes, celebration cakes. And as you say, it's a franchise operation. It's pretty resilient demand. You know, there will be some headwinds. The general backdrop for consumer is you can't really see the UK as just one consumer. There's sort of the young demographic are doing fine. They probably had a pay rise. You know, people in the southeast, there were quite a lot of people built up quite large savings. On the other side, there'll be households where, you know, 2 partners are working and yet they're still having trouble with gas bills and perhaps the mortgage as well. So different demographics hit in different ways, but generally they've traded pretty resiliently. And, you know, the big thing about CBOX is they've got about 140 outlets. I think they have demand for another 45. There's potential to put kiosks in supermarkets. I know they're very positive in that around some of the sort of Asda type, Morrison type operations. That's sort of ongoing. And so, you know, the cash flow is good. They've built the profile of the business, and it just feels like a long-term growth stock. You know, there's a few sort of dissenters around the consumer demand, and they've had to put a little bit of cost in around governance, and there was some issue about communications around the accounts. But we've met them 2 or 3 times since that. It's not a fundamental problem with the accounts. It's just communication, basically.
Yeah, they've got a rock solid balance sheet, £4 million. I did notice their like-for-like store sales have just increased, actually. They got hit, I think, at the start of the year by the sort of ultra-hot weather, their financial year, ultra-hot weather and overseas travel. But now, back into autumn, it started to sort of come back, and they've sort of positive like-for-likes.
Yeah, well, even if that isn't the case, just the expansion of the store network, franchisees are paying for it. It feels like it should increasingly generate good cash. Yeah. Nice dividends. So it's sort of great for a reasonable price, which is kind of where we are throughout the whole portfolios, really.
Yeah, good GARP stock. Now, just moving up to a sort of like slightly up the food chain, we got Whitbread, the owner of Premier Inns and I think it's Beefeater and Brewers Fayre and stuff, but mainly Premier Inns. Actually, this is my go-to provider of accommodation on the road for my family. So you've got my piqued interest. What's your latest on Whitbread?
Yeah, it's value for money offering. It's sort of obviously under lockdown. Premier Inn wasn't a great place to be, but people are out and about. There is a consumer recession, but there's still an unlock factor. Only last Christmas, of course, people were still locked down in Christmas of 21. And actually, they've been trading pretty well. The upside to the shares, perhaps not necessarily realised, they've deployed about $1 billion in Germany. So you're right, it's the Premier Inn hotels, also expansion into Germany, making about a 12 to 15% return on capital. You can buy them, currently they're about replacement value, which is too low. But you've actually got Germany, which for about £1 billion of capital is not really making any return. And that's because you have to put 20 or 30 million in to run the operation. But that has been improving. So it's sort of just passed through break even, but probably will get up to 12 or 15%. So there is upside around the value of that, but also the lower returns or the break-even situation of that is probably depressing the overall operating metrics. So the upside to £30, 35, and a steady grower at 10, 12% probably. Yeah,
they've been getting market share, haven't they, for the last 2 or 3 decades?
It's an unfortunate fact that they will take market share from some of the independents who will struggle, unfortunately.
Yeah. Now, again, there's no popping down the food chain. I mean, I've had just anecdotal evidence, but I live in Birmingham, and that's been quite sort of busy during the centre but apparently Oxford Circus and London has been absolutely heaving. Now, I noticed one of the portfolio stocks, you've got XP Factory, which is the owner of Boom Battle Bars, which has got a sort of flagship store in Oxford Circus. And it's got the sort of the escape hunt type of premises as well. What's your sort of, or escape room, is it? What's your sort of view on XP Factory?
They raised money, as you know, about 30p a year ago. And, they promised to expand the number of these Boom Battle Bars out to 26, including Oxford Street, as you mentioned. And they've actually opened them, but it's sort of quite rare that you go from 6 to 26 as they have. And the shares have roughly halved, clearly around concerns about the consumer demand and that whole leisure. But they did the deals on very attractive property deals. And actually, the operations have traded pretty well. Experiential leisure, people getting out and about. And the customers are in. I did go to Oxford Street when it opened, and I'm afraid I raised the average age by about a couple of years just on my own.
Did you try the axe throwing out?
I haven't done the axe throwing, no. It was fully booked. But no, the demographic is kind of your 18 to 32, 35. Yeah. It's people who perhaps don't have their own house, don't necessarily have gas bills. There might be a bit of pressure, but they've probably actually got a pay rise. That kind of sort of lower paid, younger demographic are getting the sort of 5 to 10% pay rises. They work out on Saturday morning if they've got enough money, and if there's cash there, they'll go out and have a good time, meet people, which they haven't been able to do for 2 to 3 years. And okay, they'll do that in a decent pair of trainers as well, which like JD Sports.
Yeah, I was just coming on to that one. Yeah, very nicely done.
Yeah.
JD Sports? I mean, you've had, surprisingly almost, you've had Nike before Christmas putting its numbers together, and its shares responded by going about 10, 15% on the day. And it does appear as though that leisure type of sports stuff is selling through quite well, actually.
Yeah, it's a younger demographic again. It's as I say, they wake up on a Saturday morning, work out, they've got enough money, and go and buy a pair of trainers if they've got it. And it's not so pressured at all by the general consumer headwinds we've got. The stock market's been saying, of course, it's a lower income sort of clientele, and that's a problem. But and the shares came off from 250. I think they hit 92p on the low. We haven't actually seen a downgrade yet. The business is about 40% UK. They have operations in the US and Europe as well. But actually, I think we're sort of hearing that actually they probably had quite a good Christmas as well. So they're sort of 120, 130, but they have come off from 250, and it was one of the better growth stocks of the last 10, 15 years, really. And the other thing about it, of course, is they've got cash on the balance sheet. So, okay, the trading might turn out worse. We're not predicating the buy on this stock on that there won't be a downgrade. As it happens, there hasn't been. But it has the balance sheet to ride through any problems, should there be any.
Yeah, and it's only trading on those sort of 11 or 12 times PE. So you've got a good quality, solid market share gaining type of stock there with a big brand trading at a rock bottom valuation.
Yeah, and I'd agree with all of that.
Now, just moving on to a bit of technology, another sort of beaten down area. And I know we had a really brilliant chat about 12 months ago on FD Technology, which has got three divisions. One of them is the KX Insights, which you said was the crown jewel. And then we've got the FD Technology, which is a sort of IT services business for capital markets. And then the advertising business, but that's the IT advertising, the MRP. Do you want to take us through your latest thoughts on this one? Because KX seems to be really knocking the ball out of the park.
Yeah, KX has grown at 30 to 40%. I think some of the brokers have got 10 to 12% revenue growth in for that division. That's quite important, because if it grows at 30 to 40%, the drop through, they hang on to a lot of the revenue, because it's sort of 70 to 80% of the revenue will stick at some level to the bottom line in that KX business. These are very valuable business. They're very highly valued even today in the US, and that's fairly central. And the KX business at sort of 60 to 65 million ARR, probably growing 20 to 30% this year, has the potential to get to the 100 million mark, which I think would start to get attention from the US. Now, added to that, of course, we've had a deal from Microsoft, which works at two levels. The Microsoft salespeople will be able to sell a product for this sort of big data, time series databases, which I think is interesting, but they'll also white label it and make it a Microsoft product as well. So the KX business historically has been niche. It's been quite broad in a small niche, but this makes the whole thing a lot more scalable. So it would go from sort of very specific banking type markets more broadly across Internet of Things, and will be used in those sort of applications, perhaps increasingly through this year, sold via Microsoft. So that's why there's really strong confidence around the 30 to 40%. You're probably arguably paying nothing for that KX business at the current sum of the parts. The backdrop, as you say, around the way that people have been invested, growth investors have had redemptions. We've had redemptions in small cap in the UK. Some of the parts arguments aren't really the sort of things that people do in a downturn, but that some of the parts argument absolutely is there. The upside is 20 to 25 pounds, and that should go at 20 to 30% per annum from, as you say, 14, 15 quid. So, it's a really, really strong idea, and it's not the smallest name out there. It's a few hundred million. I think increasingly the investor base might migrate towards the US. I think if they saw it, they'd see it for the bargain that it is. Yeah.
And I think you've got some pretty acquisitive private equity guys. I mean, I wouldn't be surprised if you had Tomo Brava putting a number over this, or putting a slide rule. It may be a bit small for them, but it's exactly the kind of thing they'd look at. Would be take out the software KX business, which is absolutely flying, keep that, and then sell on the likes of FD Tech to Accenture, and perhaps the MRP to somebody else. I don't know, but that's how these guys' minds work, I'm sure.
Absolutely, yeah. I mean, but the whole thing is about 1.2 times sales, and the software business ultimately probably, US audience would easily pay somewhere between 3 and 10 times sales for that, and the consulting business is worth, I suppose, 250 to 350 million on its own, probably.
Yeah. And you never know, even Microsoft might want the KX business. I don't know. So anyway, that's all hypothetical. Let's move to WANDisco. Now, this is one which has been around for years and sort of like, I don't know, 10 years ago was at about 30 quid, came crashing down to about 3. But now has just really started to blossom and had a series of really big sort of like 8-figure type deals, contracts for its data migration into the cloud in real time. What's a sort of like the trigger behind this? Well, why is it suddenly decided to sort of really sort of like flourish?
So I think it's the scale of data. So you're talking about big data. So they would take for companies such as telecom companies or automotive companies, maybe operators of wind farms, they'll take huge quantities of data and park it into the cloud, which is cheaper for those guys. The existing providers can't necessarily do it. People like Microsoft can't do that because they've been asked and they couldn't. And so it's relatively sort of alone in its ability to do that. So the clients are global. And you're right, they have won subsequent, record orders, and they've had a really strong 12 months. We picked the shares up at £2.50, £3. I think they're £8.80 today.
Yeah, well done.
Well, we are going at a reasonable price. So, it's not cheap on the basis of what we've seen to date, even with those order wins. But just, in recent meetings we've had with the company, there's just a huge confidence in the order book, the quantity of things that may come through, the quantity of things that may or may not be in negotiation, which we wouldn't know about. But clearly the company is very confident that, where they have 1 or 2 telecom customers, there's no reason why that can't be 5 or 10. And, where they're selling into certain automotive companies, then there'll be more. And things like the rail market, there's absolutely no reason why that couldn't become much bigger for them. And it's just rare that you see something that potentially can grow its revenues 50 to 100% with the kind of operation, the business model they have, which is an incredibly strong drop through that you get in sort of cloud computing, IP licensing that they're in.
Yeah, no, and I know Christopher Mills talked about it sort of 12 months ago as well. So I think, again, you're in very good company there. Just moving now to a company that only listed just recently. I think it's a company called Sondrel that raised around about sort of like £20 million in October at 55p. It's currently trading at 64. Never heard of this one before, but it came out with a good contract win this morning, which is effectively doing all the design for a silicon chip, bespoke, tailored to a specific application in the edge sort of cloud computing, I guess. Do you want to take us through this one? Because again, it looks good value on sort of 1.5 times sales.
Yeah, no, I totally agree with that. And, it has been a buyer's market in small cap. And when this company approached sort of investors, the house broker was saying 80 million valuation. It's always too high. Eventually, they raised that 20 million at a valuation of about 30. So
wow.
Yeah, you'd say with an IPO, kind of where do you get your value? In an IPO, well, it goes through the process of price discovery at the float. They historically have designed chips for the likes of Tesla, Cisco, Apple. I think they've designed them for, but it stopped there. So they had 100, 120 people that do the designs, they get paid for it, and then move on to the next one. The money has been raised so that they can then move into prototyping and supplying the products. So potentially that makes the business model more like companies such as Socionext, which actually floated in Japan, where the metrics could be that per employee, they could be getting 5 or possibly 10 times as much revenue per employee on a sort of 6 or 7 year view. And I think because of the valuation, it should be good over the next 12 months. The order today is great. But then it's a sort of slightly longer term story about, massively improving business model, really.
And what about I know it's a difficult one. We've probably only spoken to the guys, but the CEO, Graham Curran, is the founder, isn't it? So what's your sort of general view on sort of founders? Because they've got a lot of skin in the game, these guys, and usually pretty motivated.
Totally agree. Thank you for raising that. No, we invest in our own funds, and we like it when that's the case. They came to raise money to expand the business, not for an exit. Now, at some point in the next 3 or 4 years, I don't suppose having floaties is going to be buying more shares, but he might sell some. But it's still very much a meaningful commitment to the business, both in terms of running it and financially as well.
Another one which is just was IPO, I've never even heard of before, is Lifesafe, which does a sort of like a 5-in-1 fire extinguisher. So it not only puts out your sort of your water, with fires with water, well, sort of normal fires, but electric fires and all kinds of different problems in that. And they've got also fire detectors and smoke detectors and stuff like this. But again, they've put out a trading update just before Christmas. And actually, they beat their trading update, well, the sales forecast by a good sort of 20%. What sort of attracts you to this one? Because again, it's about 1.7 times sales, and so it seems to have good, unique IPR.
Yeah, so the attraction of this is, whilst it's selling into the consumer, is that the technology is something that doesn't appear that you can buy elsewhere. So the ability to put out the 5 types of fires from one extinguisher, lightweight, is quite attractive. Now they are selling it through Amazon; it's doing well, and I would expect it actually is exceeding expectations. And the shares actually didn't do well from float, and we picked them up after they'd fallen. But I think the opportunity, and when they said that trading was going very well, they did say that there is the opportunity for this to put out, battery fires, which of course is highly relevant. Lithium-ion batteries for cars, automotive, sometimes get. Once they start to overheat and you get a fire, then it's really difficult to put them out. But there is evidence that the company is saying that this is, could be used in cars. Now, they've said that they're looking to expand that and develop relationships with OEMs. If they were to do that, then you could see how, the shares could be multiples this price.
Yeah,
so it's slightly speculative around that. It's one we put in our new small cap fund, which is a small fund. Our special sits fund, which is a bigger fund.
Yeah,
we'd buy that later on should it come through.
Yeah, another one was been around for a bit more, quite some time, but it's had some interesting sort of news. Is Trufin, and it's got sort of like a group sort of structure, and it's got Satago, which does sort of like early payments and stuff like that for in big deal with Lloyds and Sage. But the one we just had a bid in for was £26 million, was their Oxygen, which was a sort of like a trade finance type of business, I think, sort of online. Do you want to take us through this one? Because it seems to be a good unbundling play, but again, the market seems to just like not give it any sort of credit at all.
Yeah, I think Oxygen and Satago, how we pronounce it, would potentially be worth a market cap. The other two holdings, are doing quite well, and it's one of these. Perhaps it was an early stage fintech business 5 or 6 years ago, and the business, or maybe 10 years ago, the businesses are at that point where actually they're sort of becoming self-sustaining. So, Satago, the Lloyds deal, that could be really very positive. The quantity of clients that Lloyds have, and further agreements with the likes of Sage, as I understand it, potentially that could be hugely scalable. And so Satago, for all I say, it could be worth the market cap. It could be worth quite a lot more than that. And this year is going to be critical around that. So we hope for news flow there. Oxygen, the bid I don't think was high enough, because having been through 7 or 8 years of paying 27 million. Is a highly recurrent revenue. If they were to go out and present that business on its own, I think people would be quite enticed by the growth prospects and just the steadiness of the recurring revenue.
Mm-hmm. Yeah, I don't think that offer was put any synergy value in it at all. That's for sure. I think it was quite a lead offer. Now, just moving to another sort of area that's been absolutely hammered, largely because of interest rates, is the house builders. And now you've got sort of Vistry in there at all, in the sort of bigger. The CEO, I think, is Greg Fitzgerald, who's did a brilliant job, I think, originally in Galliford Try. And in fact, I think he bought a few years ago their housing business, but has now sort of like also just about 6 months ago bought the Countryside Partnerships housing business as well. So they've got quite a big group, and they have been growing both organically and by. What's your sort of latest view? Because the shares currently trade again about 7 times sort of like PE, but they're below book value, actually, sort of 15-20% below book value.
I think the house builders in general, I mean, it's going to be a difficult year because of interest rates, so prices and volumes might be down. But in general, the house building sector as a whole, even notwithstanding that, it trades quite a discount to assets. But with this one, I think it's more resilient because of that partnership housing that you said. It's more deals with local authority housing associations that will stand up more, even if house prices are difficult. Price tag is probably £8 or £10 today, but taking on board some of the difficulties around that outlook, but that would grow quite significantly if once we're through the worst and start to see any recovery. The general partnership housing, when Countryside was standalone, people were sort of thinking of 12 to 15 times earnings for that, and it's quite long-term contracted revenue and quite resilient.
Yeah. Well, yeah, there's certainly one to have a good. And again, just moving on to another area that's been hit by obviously interest rates and consumer sentiment is One Savings Bank, which is obviously it does buy-to-let mortgages for landlords and stuff like that. What's your view on that one? Because it's sort of like gotten really knocked and then it's actually started to come back actually as I think as the Trusonomics sort of wore through the system and the UK yield curve started to drop. It means that it's going to be less expensive for landlords to actually get mortgages for their buy-to-lets.
Yeah, so I think sometimes the headlines distract people. I mean, the housing market, there are some headwinds out there. Rates were higher. There was uncertainty in that marketplace, but One Savings has actually much better returns than the high street banks, and pretty lowly valued. The loan to value is about 60% on the mortgage book.
Right.
So house prices would have to go down a very long way for there to be any problems. But it actually looks like it's got excess capital. So we could see increases in the dividend or share buybacks, and actually a lot of the revenue they get is remortgaging, so people rolling over mortgages they've already got. And notwithstanding that, the rental market is really quite strong in places like London. So for all that there is a problem with the housing market, people don't buy houses, they might have to rent a bit longer, which perhaps is pretty good for buy-to-let, people that take on buy-to-let houses.
Yeah, I think you're right. I mean, certainly that whole rental income for their customers is going to be crucial, isn't it, to service the mortgages, I guess. But anyway, we'll wait and see on that one. Now, I guess a real sort of dream stock for specialist or special situations is Melrose, because it's always in a sort of special situation. It buys cheap and sells at a higher price, and it's had a really good sort of record in doing that. And I think it bought GKN about sort of, I don't know, 2 or 3 years ago. It's sort of quite a sort of controversial deal, and they're sort of like been picking through that particular group and improving performance. And do you want to take us through this one? Because it does seem as though it's going to spin off its auto business. Yeah,
the Melrose team are high regarded over far longer than the 4 or 5 years. It's a very long-term track record. And of course, they did very well, and the business got bigger. They bought GKN, which was a pretty big business to buy. Now, they have improved it, but of course, automotive and aerospace, which GKN is, aerospace has been hit by COVID and flying hours, and automotive was hit by, supply chain and lack of components. So there's actually now recovery potential in it. And you're right, they're talking about this year, sort of probably second quarter, demerging the aerospace business. So
I think it's the auto.
It's business. The automotive, yeah. So the aerospace business, would stay, and I think the management are probably more likely to stay with that aerospace business. The thing is really not highly valued, assuming some sort of recovery here in automobile and aerospace, which we are getting. And I think there is significant upside perhaps to the aerospace side, which although is probably half the value, but it's certainly not been reflected in the share price. So you quite easily get to £1.70. I mean, they're sort of 130, 140 at the minute, having been a pound where we initially bought them. The aerospace business is sort of the automotive business might be a bit orphan because the stock market hasn't historically liked those. But I think as a standalone entity, they maybe make acquisitions, or they might make a merger or something. Or might go to private equity or something. But I think value will be released by the demerger, just because the optionality that both sides will have, and the aerospace side, he's got some very good sort of long-term contracts in aero engines and things. But potentially that will be the vehicle for the management team that done so well over the years.
Yeah, and I guess there's always, once you say you're sort of spinning something out, there's always an outside opportunity that it attracts somebody to put a number on the business and sort of take that spin out issue away from the management team and just do it.
I think so, but the reality is, though, I think they would have liked to have sold the automobile business, but they didn't. But I think the aerospace business might be one of the more, you know, attractive businesses out there in sort of mid-large cap in the UK after the deal. It might just trade cheap for a while, and you know, it's not often you see something that is fundamentally that underpriced really in large mid cap.
Yeah. Now, just moving on to sort of the healthcare and agri-tech, there was another one which is IPO'd, which is a One Health Group. Again, never even heard of it before. CEO presumably is the founder. I don't know, Adam Binns, and I think it does essentially. It's sort of like a private healthcare business, and does sort of like procedures for sort of orthopedics, knees, hips, I'm guessing, and sort of gynecology ones, and also sort of, I don't know, endoscopies and stuff like that. And yeah, I guess this is the whole sort of like NHS massively under pressure, needs assistance to do procedures, and the massive, huge backlog of sort of, you know, operating waiting lists.
Yeah, so I mean, you say they do them privately. Actually, there's a slight subtlety to it. If you go along to your GP and you have to have your knee done or the hip or something, if they come back and say there's a 4-month waiting list, you do have
2 years more likely.
Yeah, well, you do have the option under the NHS to elect to get it sooner, and that's what these guys do. So they've built the business, they've grown it. The founder was originally a surgeon, and he's grown it 10 to 15% underlying. You know, COVID was down year, but they've managed to do that over the years through their own cash flow, and so they will use private hospitals to do these sort of NHS funded procedures. But there's a little fundraiser around this where they will build a minimum facility where they would actually be able to use that and internalize the money that they would otherwise be paying to these hospitals within the group. So it feels like you know, defensive growth out with what's going on in the broader economy, with this sort of extra sort of bottom up sort of kicker. It might take them 1 or 2 years to build such a facility, but I think, you know, there'll clearly be a good step up in profits when it happens.
Yeah, I mean, I was just looking at their margins, and forecast is only about, well, just less than 3% for operating margins. There must be a huge opportunity over time when you just scale that business to increase that significantly, because if you've got your own facility, you'd expect your operating margins to be significantly higher than 3% doing this type of work.
Yeah, I think the operation, the headline charge is sort of 10 or 11,000. Well, they'll be paying 6,000 or 7,000 to a private hospital. Obviously, quite a lot goes to the doctor. Yeah, there's about 1,200-1,500 quid a margin, I think. But yeah, obviously there's capital cost to doing it, but it will bring really good, you know, upside into the group, I think.
Yeah. And then the final one in agri-tech is Plant Healthcare, which again has been around for some sort of time, but they basically have got sort of like lead products that help improve the yield of certain crops and cereals and stuff like that. And take us through this one, because if they can get this formula right, then it's going to certainly save the cost of living crisis. They'll be able to buy a box of cornflakes fairly soon.
Yeah, well, of course, the value of improving yields is that bit more, because the agricultural crops are worth more. A lot of them, sometimes soybean and stuff, or oils, can be interchangeable with other sort of carbon-based fuels. They've had a product called Harpin, which has gradually been growing, and there's some very, very big markets for there, but they're conservative markets, so it's a slow grower. But more recently, they just launched a product called Sauri, which is like a vaccine for plants. It's much higher gross margin. It's bigger opportunities in places like Brazil and in the US. So, and those are just starting to sort of gradually go into distribution with partners and you know, getting used in the field, literally. And so there is the potential for the revenues to go up towards 25 million in perhaps 2025, might be 2026. But there'll be the gross margins on the newer products are a lot higher. So, we have seen upgrades. We're seeing progress of the revenue line. There's quite good drop through. Seeing pretty well financed. Management is a slightly newer team now, and they seem to be quite confident they'll do more than is in the forecast. But I think they're trying to keep forecasts low. But it could be a good one. And historically, you're right. It's sort of been quite slow. It's made slow progress, but it feels like a step up in the quantity of growth and the amount of margin they'll keep.
Good. And then just broadly, sort of a bit more on the macro, we've obviously got the US CPI, which is coming out this week, etc., which will be a big sort of market mover. But more importantly, perhaps, is the whole sort of like year-end earnings season, which is kicking off with some of the big banks and stuff. Just generally, what are you sort of anticipating in terms of sort of like, the earnings season in the UK and the US, but in terms of is there likely to be a resetting the bar for 2023 when they talk about their outlooks, or how do you see that playing out?
Yeah, I think as we approach the beginning of February, you'll get some of the year ends. There'll be a few companies guiding downwards. Some of them, will be disappointments. It is a stock pickers market. The one thing in the UK, though, particularly in the sort of micro cap, the sub 200-300 million market cap area, I mean, just there haven't really been many buyers of anything for about a year. We've seen some recovery in the last few weeks, but it's the recovery we've had in stocks. It starts with the bigger names, the Melroses and the Whitbreads. It goes into mid cap, it will come into small cap, and later it will go into micro cap. So why bother? Well, the reason you bother is because the upside is potentially a lot more, because there's been an awful lot of selling going on from retail, from the small cap investors who don't want to sell but had to, and then sometimes the generalists who sort of have a go as a hobby in micro cap. Under a bit of pressure, they quite quickly throw in the towel. But all of that could actually, we see any sort of sign of a pickup in investor appetite, sentiment. All of those things reverse. Of course, people start buying stocks and they go off.
Yes, which is unusual.
Yeah, well, you buy a share at £1, and it, if it doubles, then you've got £2, haven't you? And then, of course, you go out and buy other things, maybe buy two names. That's sort of what happened under sort of Tesla and Amazon and COVID in 2020, where people were making money telling their friends about it. Clearly, that's, in the retail market, a lot of sentiment has been destroyed. It's not what people wake up in the morning and think they want to do, but that will change. So, the economy is difficult to forecast, but in investor sentiment, people have been really pretty pessimistic. It's been pretty bad in small and micro cap, but that's why it's a buyer's market. That's why we just launched a small cap fund, really.
Yeah, well, that's a great place to end on a positive note. Now, in terms of if people want to put their money into the Crux small cap or the micro cap or even the special situations or any of the other funds, how best to do it, Richard?
So we're available. I mean, it's £100 minimum. It's our fund is called TM Crux. So we have a TM Crux UK Special Situations Fund. The TM Crux UK Smaller Companies Fund is the one that was launched in November. As I say, it's £100 minimum. It's very reasonable charges, no 5% up front or performance fees or anything. And we put quite a lot of our own money in the fund. So I've got plenty of my own money in both of those funds. So it's sort of skin in the game, investing alongside what we do on the same terms, really. And so you can buy them on Hargreaves or AJ Bell. Of course, anybody would, it's not for me to recommend that to anybody. They have to go and see a financial advisor who would have to understand everybody's particular financial circumstances. That's the disclaimers we have to use these days. But, we're certainly involved in them.
Good. Well, you've got a brilliant mix there of sort of like value stocks, GARP stocks, and special situations. So I'm sure there's a lot of good ideas that investors could pick through. So thanks again, Richard, and look forward in chatting in about sort of 6 months' time.
That's brilliant. Thank you very much.